Our next iteration of Discerning is we're going to start making loans to growth companies in gambling. And so very specifically, what we're going to be doing is we're going to be making loans for user acquisition. So it's called user acquisition financing.
Hey, this is Jesse here, and you're about to hear my discussion with Davis Catlin from Discerning Capital, which are growth investors at the intersection of online gambling, sports, media, and technology. Recorded live on location at SBC Americas in Fort Lauderdale, Davis reflects on how the first 2 years of operating Discerning Capital has given him more empathy for founders, why they've invested in challenger brand operators such as Picklebet and Midnite, his analysis of a potential sale of Bet365, and the big news that he's revealing for the first time exclusively in this episode. Discerning Capital is launching a new financing model for high-growth gaming companies through the issuance of multi-million-dollar loans for user acquisition marketing. It's a funding model that's existed in other digital product verticals and now making its debut in real money gaming through Discerning Capital. I always learn so much from talking with Davis and hearing his perspectives, and I know you will too after hearing this episode. But before we get started, heads up that the Canadian Gaming Summit returns to Toronto in a few short weeks, and Betting Startups wants to make sure you get the best possible discount on your ticket. Look in the show notes below for a discount code to receive 50% off your full event pass, and I look forward to seeing you there. Optimove is the #1 player engagement platform, and Optimove Ignite Plus is its program to support early-stage iGaming startups. If you're attending the Canadian Gaming Summit in Toronto on June 17th to 19th, come visit the Optimove stand to learn more about how Optimove Ignite Plus can accelerate your startup's marketing efforts. You can find Optimove at stand A242 and tell them that Betting Startups sent you to receive your first month free. All right, we are back here on the Betting Startups podcast, and sitting next to me, I have Davis Catlin, who is based in Las Vegas. So Davis, you're accustomed to the heat, and I'm not, so I'm going to do my best not to sweat during our 30 minutes here together. We're sitting here in Florida right now during SBC week. How's everything going on your end?
It's been great. Yeah, I'm actually from Florida. You might not know that. Yeah, I'm from Jacksonville, Florida, up the way. So you sweat a lot more here. You come to Vegas, you forget what it's like to sweat. But here, it's like everything's sticky all the time. So
awesome. Look, Davis, you've been on the pod a couple times in our quarterly investor panels, and always appreciate you joining and lending your perspective and sharing your insights with the audience. Thought we'd bring you in today. And, obviously with Discerning Capital, it's something of a startup unto itself in a bit of a meta context. But let's just start there. It's been, I don't know how long, you can tell me, I'll guess a couple of years now since you launched Discerning. How have things been going? And just give us a bit of a pulse check on, life as a VC at Discerning.
yeah, so I definitely have a lot more empathy for being a founder now. That's the truth, like full stop. As an investor, so I've been investing for, I think I'm at 20 years now as like a professional investor. And whenever I meet people doing startups, I always say it's going to be twice as hard, twice as expensive, and take twice as long as you thought. And then when I started this firm, I was like, it's going to be easy. And what I've learned is it's been twice as hard, cost twice as much, and twice as long. So that's been the truth but it's gotten real, like, I don't know if I could ever go back. To be fair, I love it. The relationships you build, the every day I wake up hungry, I've loved, right? That's sort of like when you work at a big firm, and I love my time at big firms, but it's just sort of different. You don't have that survival mentality. You're just kind of doing a job when it's your business. And it's to provide for your family and your partners and your friends and the people that help you on that way. Like you have this sort of connection with them that is amazing. And so that's been good. I'll tell you, it does feel like we've reached, knock on wood here. We've reached to sort of the point now where we can do deals. I think when we raised for our first deal, it took us, we go deal by deal. We're an independent sponsor, meaning we don't have a fund. We identify investments and we go and raise the money today. Our first deal, I think, took us months to raise for. The next one took a little over a month. The last one took a couple weeks. And, we're now have the investor network, the expertise, the early data points to show we do know what we're doing.
Developing the muscles for it.
Exactly. And it's a different network of people that will do gambling. And I have a lot of empathy for founders because we live in regulated gambling. We're not, for largely speaking, that's what we do. That's where our edge is we're willing to be licensed for deals. We're willing to take board seats and do the licensing and the disclosures. We structure everything for that. And so we live that world of like going to find investors, right? If you care about ESG, we're not for you. So sort of a lot of the network I had, funny fact is actually was the director of ESG at my investment firm I worked at. So before I did this, but so all that network, they won't touch it. So finding the investors that will do gambling takes time. So I have a lot of empathy for all those founders trying to raise money in gambling, because I've sort of having to build my network. For every 10 people I call, try to build relationships with, half of them won't touch gambling for one reason or another. So anyway, that's a long-winded answer there to a short question, but it sort of feels like we've made it, but still a long way to go.
Well, to your point about having empathy for founders, I mean, founders by definition have to get accustomed to hearing no a lot. Sounds like that's been your experience as well, talking to investors to fund these deals.
Absolutely. That's right. I have full empathy for founders now.
So to your point, Davis, right? You announced the launch of Discerning Capital, but it was some time until the first deal was announced. If I'm not mistaken, that was Picklebet, the Australian-based operator. And then more recently, like Q1 this year, and I guess we're now in Q2 technically. So 2 deals I think have been announced this year, which, suggests like the cadence is picking up. Again, you're developing the muscle. Talk about, I guess, the deals you've announced so far, just briefly. I'd love to hear kind of where you're seeing opportunities, and I guess maybe specifically if you want to name drop these deals and just give a quick bit of context on like what compelled you about the opportunities each is pursuing. That'd be a good backdrop, I think, for the rest of this discussion.
Awesome. Yeah. So in full disclosure, the deals that were announced in the first quarter of this year actually closed at the end of last year. But so yeah, I think the cadence really has picked up. So our first deal was Picklebet, Australian sportsbook. Sort of started as an esports brand. So that really meant that it was sort of a more millennial branded. It built its product for a different player base than, say, a Ladbrokes or a Neds, for example, in Australia. And so because they were more focused and had custom built product from the ground up, all their tech was, not all, the majority of their tech is in-house. Their paybacks on players, like when they spent money on marketing, their paybacks were a fraction of what you might see at a larger publicly listed one. So there's a lot of risk when you're investing in an operator, but we saw that team execute. They're very sharp. They built their own technology, their own know-how, and we backed them roughly 18 months ago, I think is about the timeline. That business is, I think, approaching 10 times the size as when we first underwrote it. So that business has gone very well to date. And, the economics of having really fast paybacks means you can get profitable much faster. So that one's doing very well. In December of last year is when we actually closed the transactions, but the second deal was into Midnite, which is actually strangely very similar to, very similar sort of challenger brand as Picklebet. Same thing, a lot of their own tech. The team started as sort of a DFS company, then pivoted, and then sort of raised money in 2021. But this was really sort of more their growth round. They found product market fit. And we were really excited to get involved there. That team's doing really some amazing things. Again, similar things where their paybacks are structurally faster. They spend $1 million on marketing. Their paybacks on a gross profit basis are single digits months versus, say, I'd gather in the US, a FanDuel is probably running 18 months. So just when you're compounding that fast paybacks on your capital, you can grow really exceptionally quickly. And so that's been, very early, but the business growth has been pretty phenomenal. And I'll just maybe take a pause there. There's a really interesting theme on a macro basis that we're seeing is if you were to read Entain or Flutter, right? Their profit centers are where? They're the UK and they're Australia. And when you read about them, the strategy is we're going to take our money out of these markets and we're going to invest it in the US or we're going to invest it in Latin America. But that means that you have these profit pools where people are underinvesting. And so what we're finding is there's sort of the soft underbelly has been exposed of those companies, and the people coming in with better tech, better brand, sort of fresh eyes are really disrupting. So we use the phrase challenger brand for those. And our third deal we closed in December, is a company called SlotCycle. Really interesting business, disrupting the sale of used slot machines. So you kind of know when Resorts buys new slot machines, they put them in there. And then after 5 or 7 years, they've made, it's kind of shocking how much money. I'm just using one example, but they, casinos make a lot of money on those slots. And when those slots are ready to move off the floor, right now they go to the back room, they sit there and collect dust until somebody pays them pennies on the dollar for it to take them. And Jeff Jordan, the founder of SlotCycle, realized that there's a big opportunity here to bring sort of like what I call the eBay model. So, hey, Win or MGM, send us your slots. We'll come get them. We'll clean them up. We'll take photos. We'll verify they work. You transfer the title and ownership to us from a regulatory standpoint. We'll list them online. Anyone's available. They're globally available to anyone that's sort of licensed to buy them. And it's an interesting consignment model because SlotCycle buys the machine for $1. So, they buy it off and then they split the revenue. So when they sell it, instead of MGM or Wynn selling it for a couple $100 a machine, when it sells for $4,000, It might take 2 or 3 months or 4 months to sell it. You get 4,000 on the sale. MGM gets half. SlotCycle gets half. Really interesting sort of business model, disrupting used slot machines, which is a market. I bet nobody at this SBC conference is thinking about used slot machines. And I love that. It's this weird niche, and it's a great business that I think in 4 or 5 years, the big players are going to, and they already have like sort of public partnerships like Light and Wonder. So this is a growing business that most people don't think about, but that's sort of the beauty of it.
I'm literally sitting here thinking like, wow, that's a great idea. Like,
yeah, we heard it, and we were like, wow, this actually makes a ton of sense. And so being able to verify, having somebody in the middle say, yeah, this does work, it is compliant, it has the software, it's allowed to go to you, just opens up a whole new second life of machines.
well, and Lisa, which for MGM in your example here, in addition to obviously probably increasing the salvage value, if you will, on that slot machine, they reduce the burden of having to deal with this thing, right?
And it's going through a compliant channel versus the guy that shows up who is like, back of his truck, I'll take 100 for $100. Where's that going? And is he going to sell it to an illegal casino operating in Nevada? And all of a sudden you're having weird conversations about that serial number was attached to your property. How did they get that? And so by having SlotCycle put compliance, sort of visibility and data into that marketplace, you're opening up a whole new industry, which is like people only think about online, but it's actually like there's innovation in the physical world as well.
Very cool. I mean, I think last time you were on the pod, it was probably coming up on a year ago. And at that time, like sweeps was just starting to enter the conversation. Obviously now it's dominating the conversation along with, the newer entrant, which is prediction markets. I guess just as you guys take a step back and assess a landscape and some of these new categories that are emerging and really seemingly not going anywhere and continuing to capture mind share and wallet share from the regulated operators, like, do you have any theses right now as to how this all plays out as it relates to the regulated real money operators that have, spent the significant amount of capital they have to get live across the number of states that they're in and the compliance burden and all of this, which again, these new categories don't have? How do you see this all unfolding and how's that influencing, I guess, you guys' investment thesis right now?
So I think of this a lot as like, I'll start very high level, then I'll give you some specifics. So I first became like Chicken Little saying the US was going to be huge and from an online wagering standpoint in 2015, 2016. When I first started, let's say like this could get big. And the number I had in my head was I thought it could be 70 billion. And I used that because the AGA then said that was sort of the land-based industry around that time. And when you ask consumers, they much prefer to bet on their phones or wager on their phones versus land-based. So I said, okay, that's the par, right? We're going to go for that. That's the number. But I think what you found is like, what's the number you would say? What is online gambling in the US that's regulated? What's that number in your head? I always see different ones, but I think I saw one that was like 12 billion, 14 billion.
Yeah, I was
like
about
that.
20, but
yeah, sure, 20.
Take the over.
Yeah. So 20 billion is regulated gambling in the US. How much are sweeps? Another few billion. How much is all the, Kalshi going to be? Maybe a couple billion. I don't know. How much is DFS plus? A couple billion. So I still think the market opportunity is measured somewhere near 100 billion. And I think all of these are sort of competition as we creep up. But when we add up those things we're talking about, we're maybe to 30 billion. There's still a really long way to go. So the question is regulated gambling 80% of that market long-term? Those sort of people want to have a wager. So maybe not a bet with a wager. We can get cute or, gamble on an outcome or whatever you want to say. You pick your phrase, right? But I think that's where I think of this. These are sort of market share questions. I'll say sweeps has been interesting. Probably 9 months ago, maybe especially 6 months ago, I sort of tweeted about it, or I guess I didn't tweet. I put it on LinkedIn at G2E. It was like, that's all anyone talked about. In our phone, in our inbound emails, we had all these generalist funds being like, we're looking at sweeps. Can you tell us about it? And we'd share our thoughts and we share our concerns and we'd say, but this is what we're looking at. And we like this and we don't like this. And sort of, we're trying to figure it out. But we've started to hear a lot more in the last month. Hey, we don't want to lend to that. We don't want to invest in sweeps. So it actually, I'd say the canary in the coal mine is sort of saying maybe the flow of capital sweeps is slowing. So maybe that's because there's a few winners emerging. That's possible. Or it could maybe be that people are starting to ask questions about the regulatory risk. Maybe just is too much. I don't have a strong opinion on which way it goes. I'm sort of a happy bystander trying to say, if it gets the all clear, we're going to invest. If it doesn't get the all clear, we're going to probably just evaluate for the time being. But I think that's sort of how, DFS is similar. It's got a lot of interest, and now you're starting to see some winners emerge. And so Kalshi is sort of the latest and greatest, right? It's like now we're getting some, like, where I've got a few friends that work in hedge funds and they're like, what do you think of Kalshi? And it's like, I think there's perfectly legitimate reasons for Kalshi to take the argument to make. And if I was them, I'd do the same thing. I would make that argument. I also think that if you're a DraftKings or FanDuel or anyone on the regular side, there's also perfectly legitimate reasons to say, hey, but wait, we're under these regulations. And so you got one of these where everyone's pointing at each other saying, it's not me, it's
The
you.
Spider-Man meme or
Exactly,
each other,
100%. That's where my head was. So I don't know, like I'm intrigued by it. We've had a few sort of operators that are on the regulated side, not the big guys, but be like, if you're a subscale operator in Europe, could we launch this? Could this be our way to get in the US for cheaper? And I don't know. I think it's yet to be seen. And from my standpoint, how this plays out. But my gut is that the states that have legalized gambling are going to start getting a lot of pushback from the people that have spent the money and are paying the taxes to say, hey, if you want my taxes in this state, you've got to create rules governing this. And I think also Kalshi and those guys, they have a real structural issue around American bettors. And with all due respect, if you're watching, they're not very sharp. They take props and they do all sorts of crazy things. And that's really hard to do on Kalshi. How do you set a market for a 4-leg parlay on your favorite college football team? Hard to do. So I just think that there's sort of limitations, but will it be in that sort of that cone we're saying if there's 30 or 40 billion that's sort of wagering today? Could it be a few? Absolutely. And that's fine. Welcome to the party.
All right, one other random one here for you, Davis. I was at a breakfast this morning and there was a little bit of table talk at the breakfast I was at. Everybody's pontificating around the rumors of Bet365 potentially being acquired, which is a big story unto itself. But the conversation at the breakfast table was like, well, what's the play there? What's that deal look like? Is it a listing somewhere? Do they get acquired? And if so, by who? As you sit back and sort of armchair quarterback this, do you have any thoughts or opinions or convictions at this stage as to what might become a Bet365 and how that might play out?
Yeah. So, I always like to say that my opinion in a bus ticket can get you somewhere. So I definitely have an opinion. I just don't know if it's useful. But, I'll tell you, a banker approached me when I worked at a large strategic about 3 years ago and said, hey, I don't know if it was the banker's idea, if it actually came from inside of like, what would you think about buying the regulated assets at a Bet365? And again, there was no real conversation and it was just not on our radar. But I thought that made a lot of sense of like, gray markets, black markets tend to trade at very low valuations, but they're very cash flow heavy. If you don't pay taxes, it's pretty good. And then the regulated is probably a very attractive business too. And they've got a lot of in-house know-how. So I think it's a really sort of top tier global asset. But that was brought to me years ago was this idea of, and always, here I am 3 or 4 years on remembering it because I was like, that's really interesting. If they had a willingness to sell the regulated and the family kept the unregulated because that's the cash stream. So that was always in the back of my mind. But now to see they've shut down China, and it was interesting. They shut down China, but not all of Asia, is my understanding. So I'll leave that comment there because I understand that's not the only market they were in Asia, allegedly. So with that, like, it does seem like they're making the decisions that you would take if you were going to sell. So I do think there's something to it. I've had some interesting conversations with people recently over like, how big is their business? Because I think what they show in the UK doesn't support the numbers I'm hearing. And if I recall correctly, everyone listening can look it up. It's public information. I think it's called the Public House. Is that what
Company's House, I think.
Company's House, thank you. In the UK. And I think it shows like 220 million. Does that sound right? Something like that as their profits in the listed entity there, so to speak. That's not, company making $200 million back of the envelope in this industry is trading for 1.2, 1.5 billion. So there's a lot of money being made that's not running through that entity if they're trying to get their 9 billion. So I think it makes a lot of sense, but I just have this question of what would that trade for if there's a lot of gray market? Look at sort of the super bets of the world and these groups that are out there that are listed. And I'm sorry, the Betways. I forget the name. Is it Supergroup? The name that is their listing company. Yeah, I said that and I was saying yes to myself. Those things trade at like really low valuations. So like if I was a public markets investor, I don't think I'd want to jump in unless I'm buying it for like 4 times cash flow.
And from a DraftKings perspective, Davis, last question on this, but if you're Jason, if you're looking at 365, what is it that compels you about that set of assets for the US market? Is it the tech? Is it the brand? Is it just the operating excellence that they've demonstrated over 20 years? Like, what is it that they're bringing to the table for DraftKings in that scenario?
Well, I think DraftKings right now, the number 2 in the US, fighting hard to take the number 1 spot. And by buying a Bet365, DraftKings takes its, reasonable valuation. It's, it's not super group, but it's at a higher valuation, and they can sort of parlay, pun intended, that into a global cash flow super engine. I mean, let's just say the numbers of, $1 billion a year cash flow is probably, I might be low of what Bet365 does. And if you put that into DraftKings' US listing, that's really valuable. You've got global reach. You have 2 brands. You get all of their licenses. So every market Bet365's in, you're instantly launching DraftKings as the challenger brand. I think there's a lot of sort of strategic value there.
All right, time will tell. Look, Davis, let's shift. In addition to just catching up and getting your perspectives generally, we did bring you here for a bit of a reason. We talked a bit about the first couple of years of Discerning Capital's journey, and you're about to start a new chapter of that journey. I understand there's a new initiative you're launching, and I'd love to have you tell the audience a little bit about what you guys are up to next.
Yeah, so our next iteration of Discerning is we're going to start making loans to growth companies in gambling. And so very specifically, what we're going to be doing is we're going to be making loans for user acquisition. So it's called user acquisition financing. And the way that you can think about it is Discerning Capital, we're trying to find fast-growing businesses with compelling user economics and fund them. And right now we do that through equity. So we negotiate, we buy anywhere from 9% to 25% of a business. We say, you take the money, we take a share of your business. But that's not always the best way to finance your business, depending on sort of the size of your business and the size you want to raise. We started to realize there's a real opportunity to offer loans to finance the marketing spending of these sort of B2C operators. So you can think of it as a sports book. On the low side, you're probably spending 20 to 25% of your sort of revenue on marketing. On earlier stage, faster growing one, it could be the majority. So when you're raising money, it's often you're taking money from me today and you're trading your equity for it to go spend on that sort of marketing dollars. And what we're saying is we're going to continue to be in the equity business. That's our core, but we will begin to make loans so that I could say we're willing to finance that user acquisition spending, and we do it in a way that works for you, allows you to finance it. You retain instead of giving us a share of your business for it, you pay us interest, and we get a little interest, and you get to retain more of your upside.
Very compelling. I love the fact there's a new, I guess we'll call it alternate funding model available now, fast-growing businesses within the space. How do you guys, I guess, think about the trade-off between getting those large chunks of equity for what ostensibly is probably much lower interest rates and sort of the certainty that comes with that for your business from a discerning perspective? Why is that compelling to you? I mean, I get that there's opportunity there, but getting call it a 5% interest rate or whatever the number might be, that's a fundamentally different proposition than taking a stake in a business and then sharing in the upside potential of it. Yeah. I guess, give us a bit of sense of the opportunity you see there from a discerning perspective and why that's compelling to you guys.
So I think it'd be fair to say that it depends on your, the right answer. It actually was, I mean, just to be fair, it was driven by what we were seeing in the needs in the marketplace. And very specifically, some companies need to raise more money than makes sense. So if you're a small business, and let's just say your business is worth $10 million today, and you need to raise $10 million to reach scale, that means if you need $10 million, you're going to have to give up half of your business to do that. And we started to realize that when we're looking at that and say Jesse's business and we're looking at wow, this is really compelling, but I don't want to say it's predatory, but I don't want to own 50% of your business. It's a lot harder with gambling laws to raise that money and not trigger sort of licensing at investor level. So we started saying, okay, well, isn't there a world where we could give you a $2 or $3 million, equity investment and pair that with 7 to 8 million of loans? And, to be fair, our interest rates are higher than 5%. Okay. So the returns to us are really compelling, but it also is really important that the founders now have a new avenue of non-dilutive financing. And I'd say, from our standpoint, we sort of view ourselves as investors first. I'm not a poker player that became a gambling guy and then a poker player who became an investor. I'm an investor who started doing growth businesses all around the world and fell into gambling. And so since I'm more of an investor, to me, I'm yes, I love building businesses. I love being a partner and doing the advisory work and strategic relationships and all that. But also at the end of the day, sometimes the right way to invest in a business is actually on the credit side. And that might be alongside our equity. It could be the credit only, depending on the needs and the sort of cash flow.
Presumably, before announcing the launch of this new, I guess, funding model, I guess you've been out there gauging the market's interest and appetite, and also probably sizing up the opportunity for yourselves. And to that extent, what have you heard, I guess, just maybe doing a bit of customer development, talking to founders out there? Is this interesting to them? What's some of the feedback you've been hearing on that end of it in those conversations?
Yeah, so maybe I'll just take a second and introduce like how this really works, because I think that'll help set the tone a little bit for the second part of your question. So the way this would work is if a company spends $1 million a month on marketing spending, so $12 million a year is their annual budget for ads and marketing, versus taking that and, if it's your sportsbook and Jesse's sportsbook has to send out $1 million every month, what we actually do is we'll say, hey, we'll lend you, okay, you're $1 million, we'll do half of it. So we'll be $500,000, you're $500,000. You're now saving $500,000 a month in cash out the door. And we get a return, as you generate a return on that ad spending, we receive sort of a payment. So if you think about the loan, it's like as you get the return, we start here, we gave you $500,000. If you generate enough, we go to $400,000 the second month, $300,000, $200,000, and then we're paid off, say in month 6 in my example. And then we receive an interest. And if you pay us off in a year, you pay us more in interest than if you pay us off in 3 months. So there's sort of you pay us interest on your loan balance every month. But it creates a lot of alignment because we are taking the risk alongside you on, Jesse, if we spend, you're $500,000 and we're $500,000 and that loan for that month and those players don't work, you're sort of dealing with it and we're dealing with it. And we have these sort of features in there that we can get paid back, but that's there is a lot of alignment around what we're doing. And so we make that loan in January. And then we make another loan in February, we make another loan in March, another one in April. And so we build it's a revolving credit line. We sort of commit to, so our first loan is going to be about $20 million. It is a $20 million commitment. And we say, as you need financing, we will be anywhere from 50%, ad spending will be anywhere from 50% of your ad spending to 80%. And so that draws out each month. We sort of roll it. You don't actually pay us back every month. We just say, hey, if you owe us money in February for the January loan, just apply it to your February spending. And that allows us to sort of recycle that capital. You feel excited because you got growth capital. You can generate a return because your LTV to CAC is probably much higher than 1.1. So you're excited. You sort of got leverage in your model. You retained more of it. And on our side, we recycle that capital so that each loan, we don't generate much, but across a year or two, we can generate a substantial return. So with that model in place, we've already been approached for probably loans, if you just maybe guess, of 50 million. And I think that's sort of probably a pretty good intermediate target for us, is that I expect to give loans sort of in the $50 to $100 million in capacity outstanding, if you will, because it's a revolving credit line, right? When I give you 20 million, you don't spend it the first month, you grow to that over time. And so that's how I think that's a good target. I don't think there's $1 billion of this, but I think that for those companies that are sort of emerging growth companies and they're not ready to go public and they're not really private equity ready, we're a really good option there as you sort of think about coming up and through. And I think you'd be surprised that this exists, this sort of user acquisition financing. It exists out in the world. I actually think the first time I read about this was Wayfair had it. That was 11 years ago. I think I was reading about it. And that's where I first learned about it. And they were sort of borrowing money to get, people like my wife to sign up to buy pillows. And that's financeable. And we're effectively doing that. So,
and I would assume from a discerning perspective, right? Like the level of due diligence you would need to do to deploy capital on an equity basis, I'm guessing here, and you can tell me if I'm wrong, that level of scrutiny might not be quite as intense under this model on the basis, like really there's a formula, it's quite formulaic, right? Like the unit economics have to point a certain way. And if you can validate that and verify that and be comfortable with that, really that is the criteria on which you're making capital deployment decisions under this model. Is that fair? Or am I?
It is fair. Yeah, and it's just worth noting here, we actually have a underwriting partner on this. So, right, I'm an investor, but I also don't know how to do the API plugs in on the back ends. So we have a great group called PVX Partners out of Singapore. We've known some of that team for 5+ years now. And so they are the people that do the plug-in. They do a lot of the sort of underwriting and where people are generating their returns. Is it Jesse's Sportsbook, to keep using an example? Is it, does your metrics look good because you have one whale who's losing $1 million a month, or are you generating a very good return across all of your spending? And so we use them on the back end as our partner, as our underwriting partner, to evaluate the cohorts that you are financing. And yes, it is as simple as like, if you've demonstrated you can spend $100,000 a month, and you've demonstrated the next month you can spend $120,000, so with a good return, and the next month $140,000, and then you're like, well, we're kind of out of money. I'm happy to give you when you need $160,000 next month, right? And that's where we're sort of, if you think about your ad spending goes like this, you just hit a point where you run out of money, and you can only recycle out of your own balance sheet. So we just step in there, and it is very quantifiable. There's a lot of qualitative assessment as well, right? If you've got a big business in the UK, but you want to launch in the US, that's harder for us to, underwrite, especially on the equity side. That's like, oh, can you really do it? But I'm also happy to lend against your players and your spending in the UK. So it really opens up sort of new avenues of growth for people in the industry. So I don't know if that was really responsive to the question, but I just think that's where it kind of fits in this interesting dynamic is, we're underwriting the math, then creating qualitative overlay around regulations and business strategy to say, okay, well, if you're looking for this financing, we can actually do this, not that, or, and hey, that doesn't work here, but equity is perfect. And so discerning, we can offer now both.
Very cool. Well, I speak probably for all of the entrepreneurs and founders in the space to say we welcome these new types of approaches to funding. And anytime there's more access to capital, albeit slightly different context here than a traditional equity investment, is a net positive for the ecosystem at large. So very cool. Where can founders go to learn more or get in touch with yourselves to see if they're a good fit for this new program?
Yeah, so you can go to our website and send us an email, but also you can find me on LinkedIn. I respond to pretty much every direct message, but my email is davis@discerningcap.com. My partner, David, @discerningcap.com. We do respond to our emails. And so we're always available for anybody that reaches out to us. So that's probably the best way to get us.
Right on, Davis. Well, I'll let you get back to this warm Florida day here. I appreciate you swinging by and catching up, and congratulations on the launch. This is really exciting, and hope you have a great week here at SBC.
All right. Thanks for having us, Jesse.
Give you one of these. All right.
The Betting Startups podcast is presented by Optimove, the #1 CRM marketing solution for the iGaming market. 4 out of the top 5 US operators personalize player experiences with Optimove. Learn more about Optimove by requesting a demo at optimove.com/bettingstartups. And if you like what you see, you'll get your first month free.